Hi guys, Piotr here. This is LiteFinance Global YouTube channel. As usual, it's my pleasure to be with you again. As you can see, the weather today is a great weather, so I decided to choose the great topic. Today we are going to discuss 5 the most popular trading indicators. So guys, without further ado, let's jump straight into the video. So folks, indicators, it might be a helpful hand or it might be the nightmare. Depends how you are going to use them. But anyway, as I mentioned during the intro, 5 the most popular indicators right here, right now, and I'm going to try to add some tips and tricks. So the indicator number 1, very popular, and to be honest with you, the one I like as well. We are talking about the moving average, and the thing is that it might be many different moving averages, depends on the trader whom you are, how many traders, that many different moving averages, right? Overall, the moving average is a trend following indicator, and it calculates the average price of an asset over a specific number of time, right? Number of periods. Well, as I mentioned, it could be many different things taking into the consideration. The most popular are 20 moving average. On a daily chart, it's gonna be calculation based on the daily candles, right? 50 moving average. If it's on 1 hour chart, it's going to take into the consideration 50 previous candles, right? 100 is a very popular, 200 is a very popular, right? Of course, the moving average is often used to identify the direction of the trend or try to smooth out the price action, okay? So I've mentioned that the most popular, but the first tip here is that sometimes some guys are using the moving average based on FIBO numbers. So it could be 5, it could be 8, it could be 13, 21, 34, 55, etc., etc., right? The other very common used example when it comes to the moving averages is trying to trade 2 of them, and if one, the shorter, is crossing from the bottom, the longer is a buying signal, or if the shorter is crossing from the upper side to the downside, the slower one, longer one, and then it's a selling signal, right? So in that case, we can try to input another one. 1 second, please. And let's change that one. Okay, so for example, that would be the buying signal. That's what I'm talking about, right? When there is a cross, okay, going on. So that's the very, very popular way of use 2 moving averages on the chart, and well, that's the thing, all right? So trying to summarize, 20, 50, 100, 200, the most common use. The tip is people are using FIBO numbers like 8, 13, 21, 34, 55, etc., etc. The cross, if you are using the short period of time, a long period, so if short is crossing to the upside through the longer period of time, then is a buying signal, and opposite when it's crossing to the downside, it's a selling signal. So that's the thing related to the moving average, and we should go, and we should move further. The second one, RSI, relative strength index, right, is an indicator that compares the magnitude of the recent gains to recent losses to try to determine if its market is overbought or if market is oversold. The typical set when it comes to RSI, okay, the typical is a 14 period, and that's what we have here. All right, usually the lines using to try to determine if it's overbought or oversold, the standard setup is 30, which is telling us that it's oversold, or 70 when it's overbought. But the tip here and the trick, try to make your own research, try to make your own homework, and try to use 20 instead of 30 and 80 instead of 70. Well, also the thing very commonly used with the RSI are the divergence, so the difference with what the oscillator is doing and different thing the price is doing. All right, and as you can see, finally when we broke the trend line, it was the retest and strong move to the downside based on the divergence. So that's the pro tip here and trick how to use the RSI oscillator. All right, so that's the thing number 2, RSI relative strength index. All right, next one, and the relative strength index, it's an oscillator. The second oscillator we are going to talk about is the stochastic oscillator. All right, and that's what we have here. When it comes to the, it's not stochastic. Sorry, one more time. There you go. That's the stochastic, and the usual setup 533. Well, tip here: try to change and work. Maybe instead of the 5, try to use 8. But again, do your own homework, do your own research here. And the stochastic oscillator, that's trying to measure the momentum and trying to compare closing price of an asset to its the price range over the specific period of time. So that's why I told you try to use and work with different numbers, but make a lot of examples, trying to identify overbought and oversold levels. So very similar to RSI. All right, but here we have already set to 20 and 80. All right, and very similar divergence. That's what you can use as a pro tip here as well. Not only trying to look for the overbought and oversold conditions. All right, so that's how the things work here. Again, similar to RSI, is oscillator. We have the third oscillator here I want to discuss with you, and it's going to be, just one second, let's remove this one. And the third one is my favorite oscillator, okay, and it's MACD. There are plenty of different versions, there are plenty of different use cases when it comes to the MACD, okay. Well, the thing is that only your imagination can stop you. Again, you have to make plenty of tests. You have to make plenty of examples trying to determine what conditions, how to use, in your case, the stochastic, the MACD. The most common thing when it comes to the use of the MACD is the break of the zero line, and it depends if you want to use the signal line. Some people are using not the signal line, but the forest over here, and if breaking lower, and that's the signal to sell or signal to buy. That's what we have, for example, here. All right. So that's the third use of MACD, for example. Okay. Now, taking into the consideration MACD, RSI, and stochastic, all of them are oscillators, and plenty of newbies as well as some other traders are using very often and very often 2 or 3 of them at once, right? It completely doesn't make sense because, again, they are all oscillators. You are going to get the divergences here, here, and here. But in my favorite is MACD. And finally, the last one is the trend detection, and it's a Bollinger Band. Usually the interval here is set to 20, and the Bollinger Band is a volatility indicator. Consists of the moving average and 2 standard deviation lines. So that's the moving average, all right? And here are deviations, okay? Usually we are using a Bollinger Band to identify potential points of trend reversal, and by measuring the deviation of price from its moving average. All right. Well, very often we can find the way to use the Bollinger Band that people are trying to sell when the price is reaching the top of the Bollinger Band. But in that case, look, we were staying even above second standard, 2 standard deviation, so it would have plenty of losses, right? If we have constant market, then we can try to make the range. It might help us to try to trade the range. Now, once we have the expansion, we may try to trade in the after the consolidation in the way of the breakout. But the pro tip here is that if from the higher time frame, for example, you have the move to the downside at the very beginning of the European or US session, you can see that the Bollinger Band is trying to expand to the upside. It could be the trap, right? Look for the price action to the downside and look for the change of the direction of the Bollinger Band and try to follow the original trend from the higher time frame. So guys, with that being said, I was discussed with you 5 the most common used indicators. Hopefully it is going to be very useful for you. With that being said, wish you a great next trading session. See you around, take care, and goodbye.